Welcome to the Real Estate Vocabulary Set number 5. This vocabulary set will have 50 real estate terms with definitions that would be helpful. Before we get started, don't forget to like the video. Now let's begin.
Good faith estimate. A good faith estimate, GFE, is a document provided by a mortgage lender to a borrower that outlines the estimated cost associated with obtaining a mortgage. The GFE includes estimates for the loan origination fees, title fees, appraisal fees, and other costs associated with obtaining a mortgage. Government survey method. The government survey method is a system of land surveying used in the United States to divide and describe land parcels. This method was established in the late 18th century to survey and sell public lands acquired by the federal government, and it uses a rectangular system based on a grid of principal meridians and baselines. Grace period. A grace period is a period of time after a payment is due, during which the payment can be made without incurring penalties or late fees. In the context of real estate, a grace period may be included in a mortgage or rental agreement, allowing the borrower or tenant some extra time to make their payment without incurring a penalty. The length of the grace period can vary depending on the terms of the agreement. Grant deed. A grant deed is a legal document used to transfer ownership of real property from one party to another. It contains the name and address of the grantor, seller, the name and address of the grantee, buyer, a legal description of the property, and any restrictions or encumbrances on the property. Grantee. In real estate, a grantee is the recipient of a property right, title, or interest conveyed by a grantor through a legal document such as a deed or a will. The grantee is typically the buyer or recipient of the property, while the grantor is the seller or donor of the property. The grantee has legal rights and responsibilities related to the property, such as paying property taxes and complying with local zoning regulations. Grantor. In real estate, a grantor refers to the person or entity that transfers ownership of real property to another party, known as the grantee. The grantor is typically the current owner of the property and executes a legal document, such as a deed, to convey title to the grantee. Gross debt service. Gross debt service, GDS, refers to the ratio of a borrower's total housing-related expenses, including principal, interest, property taxes, and heating expenses, to their gross annual income. It is a key metric used by lenders to assess a borrower's ability to make mortgage payments and manage their debt. A lower GDS ratio indicates better financial health and a greater likelihood of loan approval. Gross income. Gross income in real estate refers to the total amount of income earned from a property before any deductions or expenses are taken into account. This can include rental income, fees, and other sources of revenue related to the property. Gross income is an important metric used by investors to assess the potential profitability of a real estate investment. Gross lease. A gross lease is a type of commercial lease where the tenant pays a fixed amount of rent and the landlord is responsible for paying all operating expenses, including property taxes, insurance, and maintenance costs. This type of lease is often used for single-tenant buildings or for smaller tenants who cannot afford to pay additional expenses. Gross leases offer tenants a predictable and stable rent payment, while landlords have more control over the property's expenses. Habendum clause. A habendum clause is a provision in a real estate deed that defines the ownership interest being conveyed. It typically includes language such as to have and to hold, and specifies the type of ownership interest being granted, such as fee simple or life estate. The habendum clause is a crucial part of a deed as it clarifies the extent of the new owner's rights and responsibilities. Hazard insurance. Hazard insurance is a type of insurance coverage that protects homeowners against damage or loss to their property caused by specific perils such as fire, theft, and natural disasters. Hazard insurance is typically required by mortgage lenders as a condition of the loan to ensure that the property is adequately protected against potential hazards. The coverage and cost of hazard insurance can vary depending on the location and value of the property. Hereditaments. Hereditaments are any inheritable property, whether tangible or intangible, that can be passed down to heirs through a will or by law. In real estate, hereditaments include land, buildings, and any associated rights, such as easements or mineral rights, that can be inherited or passed on to future generations. The concept of hereditaments is an important aspect of property law and estate planning. High-rise. A high-rise is a tall building typically characterized by having 10 or more floors. High-rises are often found in urban areas and are used for a variety of purposes, including commercial, residential, and mixed-use developments. The construction and operation of high-rise buildings require specialized engineering and safety measures to ensure the safety and comfort of occupants. Highest and best use. Highest and best use is a principle in real estate that determines the most profitable and optimal use of a property that is legally and physically possible, financially feasible, and maximizes its value. The concept takes into account factors such as zoning, market demand, and the property's physical characteristics to determine the most suitable use of the property, whether it be for residential, commercial, or other purposes. HOA. HOA stands for Homeowners Association, which is a legal entity created by a real estate developer to manage and maintain a planned community, such as a condominium or a neighborhood of single-family homes. Members of an HOA are typically required to pay fees to cover the cost of maintaining common areas, enforcing rules and regulations, and providing amenities and services. HOAs can have significant authority over their members, including the ability to levy fines and place liens on properties that do not comply with their rules. Hold harmless. Hold harmless is a legal agreement between two parties where one party agrees to protect the other party from any legal claims, damages, or losses that may arise from a specific activity, transaction, or relationship between them. It is often used in real estate contracts to shift the risk of potential liabilities from one party to another. Home equity loan. A home equity loan is a type of loan where the borrower uses the equity in their home as collateral. The loan amount is based on the difference between the current value of the home and the amount still owed on the mortgage. The borrower receives a lump sum of money, which they can use for various purposes, and they are required to make regular payments with interest over a fixed period. Home warranty. A home warranty is a type of service contract that covers the repair or replacement of major home systems and appliances that may break down due to normal wear and tear. The warranty typically lasts for a set period, such as 1 year, and the homeowner pays an annual fee for the coverage. Home warranties can provide peace of mind and financial protection to homeowners in case of unexpected breakdowns. Homeowners Association, HOA. A homeowners association, HOA, is an organization created by a real estate developer or community to manage and maintain common areas, amenities, and services in a residential development or condominium complex. Homeowners are required to pay dues or fees to the HOA, which is responsible for enforcing rules and regulations related to property use, maintenance, and appearance. HOAs can provide benefits such as community upkeep and neighborhood amenities, but they can also restrict homeowners' freedom and add additional expenses to home ownership. Homeowners insurance. Homeowners insurance is a type of insurance policy that provides financial protection to homeowners in case of damage to their property or personal belongings. The policy typically covers events such as fire, theft, vandalism, and natural disasters, as well as liability for accidents that may occur on the property. Homeowners insurance is usually required by mortgage lenders and can provide peace of mind and financial security to homeowners. Homestead. Homestead refers to a legal provision that allows homeowners to protect their primary residence from certain creditors or legal actions. Homestead laws vary by state, but they generally provide a designated amount of equity protection for the home, which can help prevent the forced sale of the property to satisfy debts or judgments. Homestead can provide important protections to homeowners and their families, particularly in times of financial difficulty. House closing. House closing, also known as settlement or completion, is the final step in the home buying process, where the buyer and seller sign all the necessary legal documents and transfer ownership of the property. During the closing, the buyer pays the remaining balance of the purchase price, and the seller transfers the title and keys to the property. The closing is typically attended by the buyer, seller, real estate agents, attorneys, and other parties involved in the transaction. Housing and Urban Development, Department of HUD. The Department of Housing and Urban Development, HUD, is a U.S. government agency responsible for developing and implementing policies related to housing and urban development. The agency works to create affordable housing, improve access to home ownership, promote economic development, and enforce fair housing laws. HUD also provides resources and assistance to individuals and communities affected by natural disasters and other housing emergencies. HUD. HUD stands for the Department of Housing and Urban Development, a U.S. government agency that oversees policies and programs related to housing and urban development. The agency is responsible for ensuring access to affordable housing, promoting economic development, and enforcing fair housing laws. HUD also provides resources and assistance to individuals and communities affected by housing emergencies and natural disasters. Implied warranty of habitability. Implied warranty of habitability is a legal concept that holds landlords responsible for providing rental properties that are safe, sanitary, and fit for human habitation. This means that the landlord is obligated to maintain the property in a livable condition and make necessary repairs to keep it in compliance with building and housing codes. Improvements. Improvements refer to any modifications or additions made to a property that enhance its value or utility. This can include structural changes like adding a new room or upgrading the plumbing, as well as aesthetic improvements such as landscaping or remodeling the kitchen. Improvements are often made to increase the market value of a property or to make it more functional for its intended use. Incidents of ownership. Incidents of ownership refer to the rights and privileges associated with owning a property, such as the right to occupy, use, sell, or transfer the property. These incidents can be separated or shared among different parties depending on the ownership structure of the property and can have important implications for legal and financial responsibilities related to the property. Income approach to value. The income approach to value is a method used to estimate the value of an income-producing property, such as an apartment complex or office building, based on the net income it generates. This approach involves calculating the potential future income of the property, subtracting expenses and a reserve for replacement costs, and applying a capitalization rate to arrive at an estimated value. The income approach is often used in conjunction with other valuation methods to provide a comprehensive estimate of a property's worth. Index. In real estate, an index is a benchmark used to measure changes in the value of a particular market or property. Indices can be based on various factors, such as the price of similar properties, interest rates, or economic indicators, and are often used to track trends in the real estate market over time. Investors and appraisers may use indices to make informed decisions about buying or selling property. Ingress. Ingress refers to the right to enter a property from a public or private road or pathway. This can include the right to access a driveway, walkway, or other means of entry. The right of ingress is often included in property deeds and can be subject to legal restrictions or limitations. Inspection clause. An inspection clause is a provision in a real estate contract that allows the buyer to conduct an inspection of the property before finalizing the sale. This clause typically specifies the type of inspection to be conducted, the time frame for completing the inspection, and any conditions or contingencies that may arise as a result of the inspection. The inspection clause is designed to protect the buyer by ensuring that they are aware of any potential issues or defects with the property before completing the transaction. Insurable title. Insurable title refers to a property title that is considered by a title insurance company to be free from defects, liens, and other encumbrances that could affect the ownership or transferability of the property. A property with an insurable title is generally considered to be marketable, which means it can be sold or transferred without any significant legal or financial barriers. Interest. In real estate, interest refers to the cost of borrowing money, usually expressed as a percentage of the total loan amount. When a borrower takes out a mortgage to buy a property, they agree to pay interest on the loan to the lender over a specified period of time, which can significantly affect the total amount of money paid back over the life of the loan. Interest rates can vary depending on market conditions, the borrower's creditworthiness, and other factors. Interest. In real estate, interest refers to the cost of borrowing money, usually expressed as a percentage of the total loan amount. When a borrower takes out a mortgage to buy a property, they agree to pay interest on the loan to the lender over a specified period of time, which can significantly affect the total amount of money paid back over the life of the loan. Interest rates can vary depending on market conditions, the borrower's creditworthiness, and other factors. Interest rate. Interest rate refers to the percentage of the loan amount that a lender charges a borrower for the use of money over a specified period of time. In real estate, interest rates are typically associated with mortgages where a borrower agrees to pay back the loan amount plus interest over the life of the loan. Interest rates can vary depending on the factors such as market conditions, inflation, and the borrower's credit score. Intestate. Intestate refers to the situation where a person dies without leaving a valid will or testamentary document. In real estate, when a person dies intestate, their property is typically distributed according to the laws of the state where the property is located, which may involve a court-supervised probate process. Intimidation. In real estate, intimidation refers to any behavior or action that is intended to coerce, pressure, or threaten someone into taking a specific action related to a property transaction. This can include tactics such as verbal abuse, harassment, or physical violence, and is generally considered unethical and illegal. Intimidation can have a significant impact on the outcome of a real estate transaction and can lead to legal and financial consequences for those involved. Invitee. An invitee is a person who is invited onto a property by the owner or occupier for a specific purpose, such as a customer visiting a store or a guest attending a party. In real estate, the legal status of an invitee can affect the owner or occupier's duty of care and liability in the event of an injury or accident on the property. Generally, the owner or occupier owes a higher duty of care to invitees compared to trespassers or licensees. Joint tenancy. Joint tenancy is a form of property ownership where two or more individuals hold an equal and undivided interest in a property with the right of survivorship. This means that if one of the joint tenants dies, their share of the property automatically transfers to the surviving joint tenants without the need for probate. Joint tenancy is often used by couples or family members who want to ensure that their share of the property goes to the other joint tenants upon their death. Judgment. In real estate, a judgment is a legal decision or court order that requires a person or entity to pay a debt or perform a specific action. A judgment can be obtained by a creditor or other party who is owed money and can result in a lien or other legal claim on the debtor's property, including real estate. A judgment can affect a person's ability to buy or sell property and may also impact their credit score and financial standing. Lashes. Lashes is a legal doctrine that may be used to prevent a party from bringing a claim or seeking a remedy if they have unreasonably delayed in asserting their rights. In real estate, lashes may arise in situations where a property owner fails to take legal action to protect their property rights in a timely manner, such as waiting too long to address a neighbor's encroachment on their property. A court may use lashes as a basis for denying relief to a party who has waited too long to assert their legal rights, even if their claim is otherwise valid. Landlord. A landlord is a person or entity who owns and rents out property to a tenant in exchange for rent payments. In real estate, landlords can be individuals, corporations, or other legal entities, and may own a variety of properties, including residential, commercial, and industrial real estate. Landlords have certain legal obligations and responsibilities to their tenants, such as maintaining the property in a habitable condition and providing necessary repairs and maintenance. Latent defect. A latent defect is a hidden or non-apparent defect in a property that is not readily observable through a reasonable inspection. In real estate, latent defects may include issues such as a structural defect or a problem with the property's plumbing or electrical systems. If a latent defect is discovered after the sale of a property, the buyer may be able to seek legal remedies against the seller. Lease. A lease is a legal agreement between a property owner, the landlord, and a tenant, in which the landlord grants the tenant the right to occupy and use the property in exchange for rent payments. In real estate, leases can be used for both residential and commercial properties and can vary in length from a few months to several years. Leases typically outline the terms and conditions of the tenancy, including the amount of rent, the length of the lease, and the rights and responsibilities of both the landlord and tenant. Lease option. A lease option, also known as a rent-to-own agreement, is a type of lease that gives the tenant the option to purchase the property at the end of the lease term. In a lease option, a portion of the rent payments made by the tenant is applied towards the purchase price of the property, and the tenant typically has the option to exercise their right to purchase the property at any time during the lease term. Lease options can be beneficial for both landlords and tenants, as they offer flexibility and the opportunity for the tenant to become a homeowner. Lease purchase. A lease purchase is a type of real estate transaction in which the buyer leases the property from the seller for a set period of time, with the option to purchase the property at the end of the lease term. Unlike a lease option, a lease purchase agreement requires the buyer to purchase the property at the end of the lease term, regardless of whether they decide to exercise their option to buy. Lease purchases can be beneficial for buyers who are not yet able to obtain traditional financing but still want to secure a home for themselves in the future. Leasehold estate. A leasehold estate is a type of real estate ownership in which a tenant holds a lease for a specific period of time, typically several years or more. In a leasehold estate, the tenant has the right to occupy and use the property for the duration of the lease, but does not own the property outright. Leasehold estates can be used for both residential and commercial properties and are common in areas where land is scarce or expensive. Legal description. A legal description is a written description of a specific piece of real estate that accurately and uniquely identifies the property for legal and recording purposes. Legal descriptions are typically used in real estate transactions and legal documents and can be based on a variety of factors, including the property's location, boundaries, and physical features. Examples of legal descriptions include Mets and bounds descriptions, lot and block descriptions, and government survey descriptions. Less favorable treatment. Less favorable treatment refers to any kind of discriminatory treatment in real estate based on certain protected characteristics such as race, color, national origin, religion, sex, familial status, and disability. Examples of less favorable treatment can include refusing to sell or rent a property, providing different terms or conditions, or offering different services based on a protected characteristic. Less favorable treatment is illegal under fair housing laws and can result in significant legal consequences for violators. Lessee. A lessee is a person or entity who rents or leases a property from a landlord or lessor. In a lease agreement, the lessee is granted the right to use and occupy the property for a specific period of time in exchange for payment of rent. Lessees can be individuals, businesses, or organizations and can enter into various types of lease agreements, such as residential leases, commercial leases, and ground leases. Lessor. A lessor is a person or entity who owns a property and leases or rents it to another person or entity, known as the lessee. The lessor is responsible for maintaining the property and ensuring that it meets all applicable legal requirements, while the lessee is responsible for paying rent and complying with the terms of the lease agreement. Lessor responsibilities can vary depending on the type of property being leased and may include things like collecting rent, handling repairs, and providing necessary disclosures to tenants. Nice work! You just studied 50 terms.
Don't forget to share this video with your friends and subscribe for more practice tests.